2. Chapter 2. So you first start out with chapter 1 and 12. Now you're going straight to chapter 2. And where are we at? Chapter 2, financial statements and accounting system. Now you got an introduction to those financial statements, but you're going to start talking about ledgers, right? General ledger, types of accounts, your source documents. This is going to be critical for you really to understand, because before you're just talking about values, general placement of those accounts in a set of financial statements, the balance sheet, statement of retained earnings, and cash flow statement, as well as the income statement, right? So those 4 different statements, you got a general introduction into those, and where the statements and where the accounts show up on those statements, and how to use the accounting equation, right? Assets equals liabilities plus equity, right? So you got a general introduction to that. Now you're going to be delving into how do we account for things? What types of accounts are out there, whether or not they have a normal debit or a credit balance, how to use T accounts to put values in one place and the values in another place so that they balance out. So this will be really critical to get through. Remember, I think I probably said this last week as well. These first series of chapters that you're going through are going to lay the foundation of your understanding. And then after that, you're just going to practice it over and over and over in different aspects of business. Okay, whether it's the sales cycle, the sales and revenue cycle, the expense and accounts payable cycle, lots of different, or the inventory and the cost of goods area of the of accounting. So it's just going to start looking at different aspects of it. But in every single one of those, you're going to be using debits and credits. You're going to be using different types of accounts. You're going to be doing, in this case, journalizing and posting accounts. So all of these 3 sections, well, actually 4 sections, are going to be critical to understand. Okay. Part of that understanding is going to come through reading, of course, and getting just exposure to the information. But the other part, don't forget, will also be very helpful for you, which is these videos, right? The support videos, which should be right here, supplementary study materials. Don't forget to use this. The more you use it, right? Debits and credits and T accounts, types of accounts, journalizing, posting, trial balance, and financial statements, and the debt ratio. The more you use these things, the deeper the learning will become. And then use your support chat, your group discussions to help work through any questions that you have. So if I go back here, I won't go through this in detail. I will do one little thing though for you. Now on Tuesday, we're going to have the office hours, and so I'll be able to go through in a lot more detail on some of these topics. But let me just briefly go back to like the accounting equation, right? And give you a feel for what a normal debit and a normal credit balance ends up being. So if we have this liabilities plus, right, equity, this is your accounting equation. There's always 2 sides of an entry, right? And that's usually in the form of like a debit and a credit. So let's say in some of these on to whatever 1-1, oh 1-1, there was we sold, I don't know, we sold a widget. Okay, sell widget, and we sold it for $100, let's say. Okay, well, in the most simplest way, let's say this is a debit and this is the credit side of the journal entry. So I'm just creating a journal entry here. Usually has a date, it has a description. They do these a couple different ways, and in fact, let me just let's just put account here because I think this is the way they usually do it in the book. So just put account here, and they'll put this description down here, right? Okay, so sold one widget for $100 for cash. Okay, let's just do that. Oops. Okay, so that's the description that kind of goes at the very bottom. But I know there's two accounts. One account is going to be cash, okay, and another account is going to be, let's just say, revenue or sales revenue. Okay, now that we've got that done, what we end up having, whoops, let's bring this back over. Okay, so what we end up having on the journal entry is a debit and credit side, and they have to equal match. Okay, so on the cash side, we got $100 in cash, easy enough. So then we have to go on the other side, which is the credit side, which is $100 in revenue. Now, this is the journal entry. Okay, journal entry has a couple of different things to it, right? Let me move this down a little bit. It has a date, it has accounts, it has a debit and a credit balance, or debit and credit values. These need to be matching in terms of the overall net effect, because remember, the assets equals liabilities split equity. You always have to keep it in balance. So in this case, we just sold one widget for $100. So now we have an account over here, cash, and we have over here, because if you remember, equity can be revenue, and expenses show up under equity eventually. And so the $100 that shows up here, $100, is also going to then show up over here with the revenue, right? So we're in balance. Now, based on this is a quick little way of figuring out what the normal balance, or to determine what the normal balance is for any different type of an account. If it's an asset account, almost always, 99% of the time, maybe about 98% of the time, it has what's called a normal debit balance. If it's a liability or an equity account, 95% of the time, there's a few, well, maybe 98%, it has what's called a normal credit balance. Okay, that means that when you debit a cash account, it increases. When you debit an equity account, it increases. That's what it's really just saying, right? That the balance in that account has a normal credit balance. So when you credit it, it increases. When you debit a revenue account, it decreases. When you debit a cash account, it increases. And when you credit a cash account, it decreases. So you'll see that, like when I do, let's say on one, I need to replace that widget that I bought last year. So let's say 1.2, I want to buy, let's say let me make this a little bigger. I want to purchase, okay, italic. I want to purchase one, well, let's just make it 10 widgets, okay? Let's say for 50 cents a piece. Purchase 10 widgets at 0.50. Well, let's see, let's do this, 0.50 per widget, okay? So that's what I just did. Now, I'll make this simple. We're gonna do this to, we'll make this a little different so that it's going to go into inventory. Okay, we're going to just inventory this. It's not going to be an expense. It's going to be an inventory item. So we're going to go inventory for 10 times 0.5, right? So that's $5. And let's then we have to do cash. Okay, and so cash is going to be for $5 because we have to match. Now, the interesting thing on this one, you're going to go, ooh, interesting. Okay, so let me just change this up just a little bit. I'm going to put that there. I'm going to put this up here. Okay, and I'm going to put this over here. And I'm just going to put this here just so I can keep the numbers kind of running in a total. But on the cash side, so now I have I have a and I have cash, which has a credit, right? A credit. This is where the T accounts come in play. Let's do this. It'll be a little easier. Cash, and we have a debit and a credit. So they call these a T accounts because they look like this typically. I'm gonna do this as a little. A lot of people do this. I don't like to do that. Just merge across, merge cells. That's fine. Whatever. And center. That's quick. Okay. So it usually looks like this as a T account. So this first entry right here, it would have been a credit of 100, right? And then over here, I would have, let's just do inventory. Let's copy this. Copy, put that here, and then we'll create another one over here. We'll make these a little bit smaller, and we'll make this one smaller. Okay, so we have cash, so we have inventory, and we have sales revenue. Okay. All right, so sales revenue is a credit. So these are our T accounts, okay? So the reason why they're T accounts, so once again, let's just put this as a left order. We'll do the same thing over here, F4, do another one over here, F4, there we go. And we'll just do another little thing right here. So we want to have a balance. Let's see a bottom, just a regular bottom. There's the bottom. F4 and F4. Okay, now we got our T account set. And these will be a total balance on one side or the other. Okay, so we had $100 and make this a little bigger so I don't have to go back and forth. Sorry. A little bit bigger so I don't have to go back and forth. All right, there we go. Now we're talking. And let's just make this equal. It's usually a debit balance, so we'll just make it equal that. Inventory has a normal debit balance, so we'll do the same thing. Inventory will equal this balance over here. And equity has a normal equals this over there. Okay, and then we'll just make this equal to this sum minus the sum of the other side of the, yeah, sum of the other side. So we'll just do that. Okay, perfect. That makes that work. And then this one will be equals sum, and we'll take all these minus the sum of all the others on the credit side. There we go. Now we can take this and move over here, and voila. Hey, okay, so we have, and I'm doing this all on one screen, so it's getting a little complicated, but we have their journal entry, we have our T accounts, and the balances from them roll into what effectively is a balance sheet. Okay, just to summarize, very quick balance sheet. So cash, we got our $100 there. Now on this one, our $5 in inventory, we got a 5 here. Okay, and then because cash is credited, we're going to put the 5 over here. So now we have 95. So what we should have, oh yeah, well, you know, and we'll just put a totals, right? So if I do a sum here now of all these, copy, we'll just put this here just because we'd like to, voila. So now our 100 equals our 100. This is effectively what you'll be learning what to do, right? And in the end, the idea is that you have accounts, they have normal balances. Those normal balances tell you how an account goes up, but it also by default tells you how an account goes down. So it goes up, cash goes up when you debit it, it goes down when you credit it, and equity goes, or revenue goes up when you credit it and goes down when you debit it. And this is how you see that play out when you do a journal entry that rolls into a T account, and the balance rolls into an account balance that shows up on either the balance sheet, income statement, statement of cash flows, other areas. Okay, that is a quick summary of what you will be learning next week. Okay. If you have any questions, give me a holler. I think that's about it. I look forward to talking to anybody that joins me on the Tuesday office hours. I hope I don't talk too quick. I just try to get through a lot of material as fast as I can. The one thing you can do though, which is brilliant with YouTube or a lot of the other things, is you can slow me down, right? You can do it at 0.5 speed if I'm going too fast, and maybe even 0.25 in some cases. But I look forward to seeing everybody on Tuesday, and let me know if you have any questions in the meantime. Take care. Bye.